How's everybody doing today? So, I wanted to make a video to start off on mortgages or at least being able to calculate it. I wanted to build an app and I basically have an app out on my website at the moment, but for the time being, let's just get the fundamentals for this part one done and then we'll move on to part two, which is actually creating the whole application. So, let's just go ahead and move over onto my desktop and we can begin. So I went out to college when I was graduating. I don't even know what I'm saying right now. Regardless, this is the formula that they taught me how to calculate my mortgage, and it might look a little bit intimidating, but this is basic 101 finances for us. So I'll just walk you through it, and then this just basically covers all the math needed for it, and we can go into building the application on part two of this series. So the formula is M equals, or mortgage equals your principal times your rate by month over the period of time. So what that means is that you have your payment. Say you get a house for $250,000, and the bank gives you an interest rate about say 2%. Here, let me change my color pin to something else. 2%, and I don't know. It's a instead of banks usually loan you out loans for either 15 to 30 years. So I guess for this starting, we could just go with a 30-year loan because that seems more reasonable. You typically have to put 20% down on a home. That is, if you're not a home time or first time home buyer, or you have some other type of either FHA type loan. But 20% of 250,000 would be 50,000 in itself. So let's just assume that we have that. So it's 200,000 times our rate, so 2%. But this isn't like our 2% here. It would be 2% over a 12-month period. I'll pull up a calculator here in a minute for you guys. Sorry, getting adjusted to this. All right. And then you have, so it'd be 2% over 12, 1 plus the 2% over 12. And then this N is your payment monthly. So since it's a 30-year loan and there's 12 months in a year, it'd be 12 times 30 or 360. So as I'm writing this all out, give me 1 second and we'll walk through it. All right, 12 times 30 minus 1. All right, so let's pull out this calculator and I can start walking through it. So 2 divided by 12, or 2% divided by 12, so let's just do 0.02 divided by 12. That gives us a very long number. I'm going to be rounding, so the answer might be slightly off, but it'll still give you what you're looking for. So it'd be 0.0016. Believe. Yep, 16. Then you're going to be multiplying that. So here, let's get that first top number, 0.0016 times 1. Hold up. It's an exponent, so let's just go ahead and do 1 plus 0.0016. And then to the 360. It gives us another whole giant number, or small number actually, because it's below the decimal, 0.002. Make sure I got that. 28449. 8449. And I don't think I can fit that in, but that's fine. I'll just make this a 5. Okay. And then do the same thing on the bottom. 016, 360 minus the 1. Let's just clear the calculator. 1, or here. 1 plus 0.0016 to 360 minus 1. All right. 0.778089. All right. And the final part of this, so let's do that 0.002845 over 0.778089 gives us that number, and let's go ahead and multiply it by 200,000. $731 and 27 cents is your mortgage. Now, this doesn't include your utilities. This doesn't include any other type of interest. What this includes is just the payments monthly for the interest rate that you got. And make sure I put an extra 0 there. All right. Say you don't want to do any of this. I do have a calculator out on my website. And let me go ahead and show you what that looks like. Mortgage calculator. So you have a $250,000 loan that you're trying to get from the bank. You put a $50,000 payment, back down to 2%. And like I said, I did round, so my number is going to be slightly off, but I don't think it's going to be off by that much. 30 years, $739, and our answer based on rounding was $731.27. So this doesn't include PMI. This doesn't include utilities. You'd have to look that up into based on your region and based on like how much you're going to be using your electricity, your water. But this is found at allinonemoney.com. Very basic math, very basic formula. I mean, like it's just a little bit of algebra. All you're doing is filling in the numbers. So let me just clear everything on the screen and just go over it again in a different color. All right. So your mortgage or your payment monthly, this could be even a car payment if you're looking for car payments. Just understand that the amount of N or the amount of years that you're paying for would be maybe around 5 years for a car. Your P is your let me just erase this because your P is what you're actually borrowing. So your P equals your borrowed amount or your loan. Your R is your rate or your interest rate that the bank is giving you. It's usually between 2%, 3 to 4 or 5%, and credit cards tend to have like between 12 to 13%, just depending on like how good your credit is. That's why in school, I don't think they ever teach you, but interest rates and your credit is very important because let's go back, for instance, to our scenario where we had a 2% interest rate, which is really good based on credit scores or based on how the economy is going. But say you have a bad credit score and you have, I don't know, maybe 4.5% interest rate, your monthly payment for that $250,000 house would be $1,113. So you have your rate divided by 12 because that's the amount. This rate is by the amount of periods. So you're paying this every month. That's 12. And then N is the amount of years. So, and again, so it's 12 months out of the year that you're paying it, and you're paying it for, I don't know, for 5 to 10, to 15. So it just depends on the scenario. And I just wanted to make this quick video based on uh, basic fundamentals on like calculating how much interest you're going to be paying. There is things called an amortization schedule, which breaks down, which we can go over in a later video, which breaks down what your payment is monthly, how much is going to your interest. So you see how a 4.5% interest when you're starting out, most of it is going towards your interest on that loan, and only like a small bit of it is going towards it. So it'll take you around 30 years to pay, and then your total interest for that time period is $164,813, as compared to our 2% interest rate, which you'd only be paying around $66,125,000. So you see how important it is to be able to, and look at how much is just going towards your interest rate or your interest compared to what you're actually paying off on your loan. So it's important to have a good credit score. But this is available at allinonemoney.com. The website might look slightly different because I'm continually changing it, but I hope this helps somebody out. And on the next video, we will go over how to build an application, maybe not to this effect, but something in Python. That way you don't have to be adding all these numbers in. You can just type in the numbers and it'll change for you. So if you like this video, please give it a thumbs up down below, and please subscribe when you get a chance. Thank you.